Sweet. All right. Factors that influence foreign exchange rates. This is going to be a shorter video. It's not too long, and it's actually pretty simple compared to a lot of the other things that we're going to be talking about. These are factors that influence exchange rates. So the US dollar, Japan, the US dollar, yen, US dollar, Swiss franc, euro, Japanese yen, okay, GBP, USD, British pound, US dollar. What really influences foreign exchange rates? Why would, and we're going to take the euro, for example, why would the dollar be a dollar and 7 euros? Okay. And what makes that change? What fluctuates and influences the exchange rates? This is what this topic is solely about, is what is making investors go to different currencies at given times. And so take notes. They're going to be bullet points again. And pay attention to and try to kind of like take an idea and apply it to each bullet point of how that influences the exchange rate. Okay. So first, economic systems. Okay. Economic systems have different philosophical and logical underpinnings when it comes to implementing laws that govern the production of goods and services, distribution of wealth, responsibilities of stakeholders, and ownership of resources. The following factors determine the rates at which currency prices represent within the global economy. All right. First, and a little bit of this is going to be, coming back to the first video of Econ 101. It's playing off of all the topics that we just talked about in the previous video. So interest rates and inflation. Remember, inflation is the rate at which the cost of goods and services rises over time. Interest rates indicate the amount charged by banks for borrowing money. People that borrow and spend more when interest rates are low results in an increase in costs. When we have low interest rates here in the US and you're borrowing and spending more money, the price of things is going to increase. That's just how it is, because when there's more excess of borrowing and spending, companies are going to charge more money. Simple, right? Very simple. Current account deficits. The government is in a deficit. All right. The current account is the balance of trade between a country and its trading partners. If a country buys more than it sells, then the balance of trade is a deficit. This is why the US is $30 trillion in debt, because we are spending more than we are receiving. We are in a trade deficit, okay? This directly impacts the exchange rate, since a country will need more foreign capital, thus diminishing the demand for local currency. If less countries are demanding our currency, okay, less countries are demanding less of our currency, the excess supply of dollars will drive down the value in the foreign exchange market. If we are not producing enough resources for other countries to buy from us, our currency diminishes in value. If our currency is absolutely demolishing the market and we are producing so many goods and trading with other countries in surplus, more people will need to buy our currency in exchange to trade our goods for theirs, right? For them to receive our goods, they have to buy it in dollars, which means they demand our currency, which gives it what? More value. So it works two ways, right? It works two ways. Government debt. Government debt. This is the total national or public debt owed by the central government. A country with large amount of government debt is less likely to attract foreign investors, leading to inflation. And this is more about other countries, not the US dollar. The US dollar dominates the market share, right? We dominate the world. The US dollar dominates the entire world because we denominate oil in dollars. And so in order to exchange oil, they have to buy what? US dollars. They have to exchange their currency for US dollars, right? However, the US is in a substantial amount of debt, but we are still leading the market in um, in the share of our currency. If you were to take Japan, though, right? Japan is a small nation and their debt is not nearly as large, but they're still in debt, but their currency is less attractive to foreign investors, okay? Because they're not willing to pay back their debt, okay? So foreign investors will sell their bonds on the open market if they force an increase in government debt. The more debt we accumulate, right, the more bonds we have to sell on the open market. This results in oversupply of local currency, diminishing its value. A bond is debt. When you hear treasury bonds, okay, or mutual funds that hold bonds, and this, you probably don't even know what a bond is. A bond is debt that you can buy, which they are willing to pay back at a higher interest rate. So you're literally purchasing debt and then getting paid more money for taking on that debt. That is what a bond is. And when we sell more bonds, in which increases the amount of debt we have, this results in an oversupply of local currency, diminishing its value. Hence why I think the US dollar is crumbling. I think that the fall of the US dollar is coming and other currencies will dominate the market. That's just an opinion. That's something I think that's going to happen. Then that is currently happening. Okay. Terms of trade. Terms of trade. Terms of trade are the ratio of the export prices of a country to its import prices. When export prices of a country rise at a greater rate than its import prices, its terms of trade improves. That's pretty simple. When our prices of goods rises at a greater rate than its import prices, our trade improves because we are selling more at higher prices than we are receiving more at high prices, okay? And this then results in higher revenue, higher demand for the country's currency, and an increase in the value of the currency, which then results in the appreciation of the exchange rate of the currency. A little bit complicated when it comes to that, right? Because there's a lot of things that lead to the appreciation of the currency, but it makes a lot of sense, right? If we are producing and selling more goods to other countries and the price of that is rising, okay, and they have to pay more money for our goods and services, we're going to make more money as a country, which means more people have to take their dollars and put it into our dollars. This results in our positive exchange rate, right? And then vice versa. If we're selling less and our exports are lower than our imports, then not as many countries are going to demand US dollars. And that goes for every country: British pounds, yens, Russian rubles, Swiss francs, okay? Every country has their specialization. Each country sells something that is unique to them. And the goal is to sell a lot of it to make profit and boost the currency's value, okay? Economic performance. Political stability is one of the many factors affecting economic performance. A stable political environment attracts more foreign investment. Look at the Swiss franc. And there's actually going to be an advanced video on the Swiss franc. The Swiss franc dominates the market because they are politically stable. Their nation is really, really good at how they, how they run the nation. That's just the truth. The US is not as good at running the nation as we used to be. That's just the truth, right? Now, an increase in foreign capital rests in appreciation in the value of domestic currency. The more politically stable a nation is, the more their currency is going to be attractive. The less politically stable a nation is, the less attractive their currency is going to be. Venezuela. Venezuela is one of the most corrupt countries on the planet. Their currency is virtually worth nothing. It's worth nothing. Mexico, corruption, drug war, gangs, mafias, drug lords, corrupt, currency is worth nothing, right? And that's literally the best example for economic performance, okay? Is political stability. Number 6, recession. During a recession, a country's interest rates are likely to fall, thus decreasing its chances to acquire foreign capital. This, in turn, weakens the currency of the country in question. The US, January, what is it, 15th? Yeah, today's what? No, I'm sorry. Today's January 16th, 2024. I don't know when you're watching this video, but as of right now, okay, as of right now, the US is facing a recession. We are facing a recession. We might be in one, we might be heading into one, but we are facing a recession. This will weaken our currency. This will weaken our currency, okay? Speculation, number 7, speculation. This is more of like a fundamental, kind of like sentimental, fundamental kind of, factor that it would influence exchange rates. So investors demand more of a country's currency when its value is expected to rise to make profit in the near future. Let's say that the US has really, really good advancement in space engineering, and we are about to send a man to Mars, right? That is expected to bring some more profit in the near future. As a result, the currency's value rises due to its increased demand, which in turn results in a rise in exchange rate. Let's say Japan is coming out with a new technology that's going to change cryptocurrency. Boom, more countries are going to demand yens to then acquire their technology, which will in turn result in a rise in their exchange rate. So there's a lot of different things in speculation that could make investors think a currency is going to be more valuable in the future, right? So that covers a good amount of things that influences exchange rates. It's not too complicated, but it's still complex, which is the same word. The ability to understand a complex subject is just learning it more and more and comparing it on the chart and comparing it to world events that are happening. And as you just continue to study these topics and they, come through in data and trading, you just begin to understand more. And the more information that comes your way, you dissect it, you take from it, and then you learn it, and then you apply it, and then you teach it. Okay, that's the system there. You learn it, you apply it, and then you teach it. Boom, and then you repeat it. So, boom, that wraps up this lesson on what influences foreign rates. Keep in mind, these are broad. Okay, there's a lot of things that goes into each factor. However, it just really sums it up. Okay, it sums it up. And as we continue to hop on the live sessions and continue making more videos and earning more money trading, we will continue to see how these impact exchange rates. So guys, that's going to do it for this video. I hope you enjoyed it, and I will see you all in the next one. Peace.